Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
Okay, so we are diving immediately into what is, well, maybe one of the most drastic corporate pivots of the year. We're talking about the transformation of Volato Group, ticker SOAR, from a private aviation company into a public vehicle for M2I Global. It's pivoting entirely into the critical minerals supply chain. And this isn't some, future possibility. This is an urgent analysis. As of today, the price is hovering between $1.05 and $1.10, perilously close to its 52-week low of 92 cents.
And that price action, it tells us everything we need to know about how the market feels about this pivot. Since that 1-for-25 reverse split earlier this year, the stock opened around $4 and has since just fallen off a cliff, a staggering 75% degradation in value. So the central question for us has to be this. Does SOAR's move represent a genuinely strategic alignment with U.S. national security, this whole strategic minerals reserve narrative? Or are we just watching a high-risk reverse merger defined by, structural dilution and some pretty major governance red flags?
My position is that this pain is strategically necessary. The entire investment thesis now is predicated on the successful completion of the M2I merger. You're transforming this entity from a, frankly, fragile and capital-intensive aviation company,
which was showing all the signs of distress.
Exactly. It was showing distress. And you're turning it into an infrastructure player in the critical minerals sector. We're talking about a crucial, high-priority national effort, a $320 billion market. So the cost of restructuring, the dilution, that's just the unavoidable price you pay to get access to a viable, high-growth arena. And, bringing in Major General Alberto Rosenda, retired, as the incoming CEO, that legitimizes the whole national strategic minerals reserve concept. It gives them the essential connections they need with the Department of Defense, with the governor's office in Nevada, and so on.
I see it very differently. I acknowledge the importance of the sector. The need for a domestic mineral supply chain is undeniable, but the equity itself, it just has all the classic characteristics of a shell recycling operation. It's defined by these serious structural flaws. You mentioned the cost. Well, let's define it. Legacy Volato shareholders, the people holding the ticker right now, they're only keeping a 10% stake in the combined company. So your investment is now functionally a bet. It's a high-stakes gamble that M2I, this private entity, can generate enough future value to overcome a 90% dilution hurdle just for you to break even. That's not restructuring. That's a near-total transfer of ownership under duress.
And see why you emphasize that percentage, but let's get into the mechanics of why that dilution was necessary and what the market structure is telling us.
Well, it's not just necessary. It's characteristic of, frankly, poor execution. That 1-for-25 reverse split back in February and the immediate relentless price bleed from $4 down to where we are now, $1.05, that is textbook behavior for a toxic split. It just vividly demonstrates that the underlying aviation business was so fragile, and we know it was, they had to pause their at-the-market offering because the stock price fell too low, that the public listing, that NYSE American ticker symbol, became the single most valuable, marketable asset the company had.
Okay, that's an accurate description of the outcome, but I would frame the motivation totally differently. What we're seeing here is a calculated, necessary capitulation event. The legacy aviation model, dependent on high capital outlay, vulnerable to high interest rates, it was simply unsustainable. The drop from $4 to $1.05 is painful, yes, but it reflects the market finally realizing the risk that was inherent in the old business model.
But the shareholders are left with what experts call sub-equity. The value that dictates the price right now isn't the future potential of M2I. It's just the residual, highly speculative value tracking the probability of this merger actually closing. It has almost nothing to do with the intrinsic value from M2I's assets, which, let's be honest, remain largely unproven. They sold the shell status, period.
I have to reject that notion that we're left with only stub equity. We are left with a 10% stake in a platform that has acquired strategic access. You're focusing on the severe cost, but you're ignoring the scale of the value being acquired here. The focus shifts entirely to the combined entity's future revenue, which is driven by securing tangible infrastructure commitments. And we've already seen announcements about non-binding offtake agreements, for example with NT Minerals for copper. Paying a 90% price to exit a business in a guaranteed decline and enter a sector backed by the full weight of U.S. industrial policy is, in my view, a strategic choice that justifies the cost. The optionality in critical minerals just vastly outweighs the certainty of failure in the old business.
I'll grant you the optionality is massive, but the governance risk you have to take on to realize it is equally massive. And that brings us to management credibility, which is, for me, the most difficult part of a bullish thesis to reconcile.
And I highlighted General Rosende for a reason. His 37 years in the military, his experience at Visa and American Express, those aren't just random footnotes on a resume. His strategic function is to provide the supply chain transparency and governmental confidence that are absolutely essential for this strategic minerals reserve push. In a sector this high stakes, that credibility is the primary asset. It outweighs the risk of the company's corporate lineage.
But we have to challenge who the true operator is here. The architect of this whole transaction, Executive Chairman Doug Cole. Focusing on General Rosende's impressive background, well, it allows us to dangerously overlook the demonstrable pattern recognition in Cole's playbook. I mean, Cole was the former CEO of ABML, which was originally called Oral Plata Resources. We have to remember, under his tenure there, the company pivoted from lithium exploration to battery recycling, and it attracted significant short seller scrutiny over alleged overpromotion and failure to deliver on promised permits.
That history requires scrutiny, certainly. But you can't just assume that past failure dictates future outcomes, especially not when the current market context is so profoundly different. The need for domestic critical minerals is a codified policy goal now. It's not just a speculative commodity play like it was 5 years ago.
But the pattern is continuing right here. You see the same steps. You take a dormant, repurposed public shell, in this case it was Inky Inc., a former mobile app developer, you rebrand it as M2I Global, and you pivot it around whatever the current hot sector is. It's moved from EV batteries to general critical minerals. The history of repurposing these shells, Oral Plata to ABML, now Inky Inc. to M2I, it suggests the core competence being acquired here isn't sustainable mining operations. It's financial engineering and rapid sector branding.
I'm just not convinced the structure dictates the intent. And besides, the merger wasn't just about the ticker, it integrated Volato's existing technology. I know you dismissed the dual-platform narrative, but the idea of repurposing Volato's Parsley document intelligence platform is actually highly relevant.
How? I mean, the leap from structuring aviation contracts to auditing complex geological supply chains, it seems like a post hoc justification for the merger.
No, it's absolutely not. Think about what the Department of Defense demands for supply chain resilience, especially for strategic minerals. They need deterministic structure and auditability. The DoD can't rely on opaque, offshore records of where these minerals come from. Parsley is a platform built for structuring complex data and ensuring transparency. That capability can be repurposed to provide the secure, auditable chain of custody tracking that is precisely what the U.S. government needs to build a genuine, trustworthy national strategic minerals reserve. And Rosende's background in payment systems and logistics makes him uniquely qualified to merge that tech with the mineral sourcing requirements.
Okay, while I can accept the potential utility of the software in theory, the current valuation clearly isn't based on software synergies. It's based on market mechanics, and this is where the skeptical position really finds its strongest anchors.
All right, let's address the market structure, because the extreme volatility is driven by the very forces you're about to describe.
Indeed it is. The market structure explains the sustained downward pressure we've seen, even with all the merger hype. Our data confirms the stock is heavily traded in dark pools. The off-exchange short volume ratio has been consistently above 35%, often spiking as high as 56, 57% on heavy volume days. And we need to be clear about what this means. This ratio indicates that institutions are internalizing massive amounts of retail order flow. They're executing buy and sell orders away from the public NYSE American Exchange.
And why is that so crucial?
Because it creates a phantom supply. When a large institution internalizes a retail buy order, they often hedge that exposure by selling a share short, or they use that internal environment to liquidate a position away from the public eye. This constant high-volume process effectively disconnects genuine buying pressure from the lit price. It acts as a continuous structural suppression mechanism. It ensures the bid just cannot stabilize or rise efficiently.
That suppression, however, is precisely what creates the coiled spring that the bulls are anticipating. We both agree on the data. The dark pool activity is massive, and the reported short interest is nearly 300,000 shares. Relative to the post-split float, which is tiny, estimated at only 4 to 7 million shares, that short position is significant, and it's risky.
But the technical picture confirms the weakness. The bearish trend is confirmed. Price is below the 50-day simple moving average, which is below the 200-day. This suggests the pressure is a liquidation, not temporary suppression. And what's more, the relative strength index, the RSI, is sitting neutrally around 50. This indicates the stock is not yet oversold, which leaves ample technical room for more downside. It could potentially challenge that critical 90-cent support level if there's any delay or setback with the merger.
And I interpret that technical risk as the necessary precursor to a volatile move up. The institutional suppression you're describing only heightens the risk for the shorts. If this merger successfully completes, or if the strategic minerals reserve narrative gains real traction, like a specific funded contract from the DoD or Nevada, those institutions internalizing orders will face potential panic. A temporary spike in borrow costs or a failure to cover on a fails to deliver could trigger a violent short squeeze. In a low liquidity, tiny float environment, any forced buying from the dark pools will send the price soaring dramatically and rapidly. The low price is the opportunity.
That assumes the institutional flow is just speculation. I maintain the data suggests the opposite, a calculated structural liquidation. Given the history of the operator, the severity of the 90% dilution, and the technical breakdown toward 90 cents, this looks like institutional hedging against further downward momentum. It effectively defines SOAR as a high-risk trading vehicle driven by merger mechanics and liquidity, not intrinsic investment value.
So we've really rigorously explored the two defining tensions of this entire entity.
We have. The fundamental conflict lies between the undeniable strategic value of the critical minerals sector, a genuinely high-priority national security objective, and the high-risk speculative nature of the public vehicle, M2I, that's been chosen to pursue it.
Precisely. It is the conflict between that structural dilution, the massive 90% transfer of equity, and the potential for a massive, necessary upside if General Resende and the team can successfully convert these strategic alliances and the Parsley platform into funded government contracts and deliver on this Pax Silicon narrative. The risk is extreme, but I argue it's commensurate with the potential reward.
My final view remains anchored in the data, the market action, the history of shell recycling, the dark pool mechanics. It all suggests that SOAR is primarily functioning as a highly speculative trading instrument, driven by the financial engineering of the merger rather than any confirmed audited intrinsic value from its future assets.
And my perspective is that for those who believe in the urgency of a U.S. strategic minerals reserve, this entity, despite its messy corporate lineage and challenged capital structure, provides the only publicly listed optionality to capitalize directly on that government-driven imperative.
It is undeniably complex. It forces the market to weigh extreme financial engineering risk against extreme strategic optionality, all at the same time.
The material provides the facts. The final judgment on whether SOAR can defy its structural lineage and capitalize on the national mandate, well, that's left to the listener.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.